Dan, you must be making money. You've been short a lot of things.
Well, I can't complain about this year so far, so we'll see what happens for the rest of it. Every day is a new adventure, John, as you know.
So what's new in the adventure today where the markets are concerned, and how are you positioning yourself ahead of so many earnings reports that are likely to influence this market?
Sure. I mean, I think with today, it's hard to separate two things. When your, number one headline when you open up Google News is Russia says if we keep supplying weapons to the Ukraine that there's threat of nuclear war, obviously that's not a good sign. So, it's hard to separate that out versus the unbelievable rally we got yesterday and, midday, and, whether this is just sort of a reaction to that. But to your question directly, I think the risk reward is just not there into big cap tech earnings. And the way I would look at it is, Tesla reported a stellar quarter, beat revenues, beat margins by a lot in automotive, which is where you want them to be, beat EPS, and that's despite everything going on with supply chains in China shutting down again, their exposure to Europe, et cetera. They still had a fantastic quarter. The stock's up 3% the next day. Netflix misses yet another quarter. Don't forget, they missed several quarters last year as well, so it's not like it was a surprise it was going to be bad, and you got punished for a 35% move the next day. So, whether you look at that or GE today, which beat revenues, beat EPS, somehow miraculously managed to maintain their range. They guided to the low end of it, which I would argue is a victory in this market. Their stock's getting crushed today. So I think that tells you what you need to know about big tech earnings, because I expect every single one of them to see forward numbers go down. And, with the punishment you're seeing in reports that you already know are going to be bad, I just think the bottom line is don't fight the Fed. That worked on the way up. You made a lot of money during a global pandemic by not fighting the Fed. Don't fight it on the way down either, because they're going to be raising rates a lot over the course of this rest of this year.
Dan, it's Deirdre, and you've been telling that to our audience for months now, and I know one thing that you've also said for the average investor is to increase your cash position. That seems wise, especially on a day like today, but do you think for the average investor they should be increasing that even more, maybe waiting on the sidelines? Is it too hard to try and catch a bottom here?
Yeah, I mean, if you can't trade this every day, if you are not willing to go short, you should just sit in cash, because it's better to lose 5-6% to inflation than it is to lose over 20% because the market's killing you. So, if you don't have time to manage it daily, that's what you should be doing. And so I 100% agree with that, because I still believe down 20% from peak to trough in the S&P at a minimum is what you're going to see before this is over. And I think it's going to take, a year plus for this to all play out, because we're just in the beginnings of a tightening cycle. And when you've seen aggressive tightening cycles in the past, whether it's the 1970s or even 1994 more recently, 1994 was the last time you got a 75 basis point increase by the Fed, multiples contracted really, really hard, and it was very difficult to fight that. And I think you're in for that again. I mean, the multiple went from about 27 times trailing to 15 times trailing on the S&P during that, early 90s tightening cycle, and I think that's what you have to worry about at this point happening again.
Well, a rather dire prediction from Dan Niles, who has been pressured to the downside. Yeah, all right. Dan Niles, thank you.